The cryptocurrency and tech stock markets are a sea of red today, with prices plummeting across the board. Bitcoin, the flagship cryptocurrency, has tumbled significantly, mirroring a broader sell-off in tech stocks that has left investors reeling. This synchronized downturn has left many investors puzzled and deeply concerned about the future of their investments. What's driving this decline, and should we be worried about the long-term implications for the market? The answer lies in understanding the interconnectedness of global financial markets and how they influence each other. Bitcoin, often perceived as a safe haven asset, is increasingly influenced by the same macroeconomic forces that sway traditional markets, such as inflation and interest rates. These forces include inflation, interest rates, and economic growth, all of which are currently in flux and causing uncertainty. Let's delve deeper into these factors to understand why Bitcoin and tech stocks are taking a hit, and what this means for the future of the financial markets. The global economy is grappling with the aftermath of the COVID-19 pandemic, which has left a lasting impact on businesses and daily life. Additionally, the ongoing conflict in Europe has further complicated the economic landscape, creating uncertainty and instability. These events have triggered significant supply chain disruptions and energy price spikes, leading to a surge in inflation worldwide. The cost of goods and services has risen sharply, affecting consumers and businesses alike. Central banks, tasked with maintaining price stability, have responded by raising interest rates. This is a common tool used to control inflation and stabilize the economy. Higher interest rates are designed to curb inflation by making it more expensive to borrow money. This affects everything from mortgages to business loans. This in turn slows down economic activity and helps bring demand back in line with supply. Reduced consumer spending can lead to a slowdown in economic growth. However, the current economic backdrop is complex, and central banks are walking a tightrope. They must balance the need to control inflation with the risk of stifling economic growth. They need to rein in inflation without triggering a deep recession, which could have severe consequences for employment and overall economic stability. The U.S. Federal Reserve, the world's most influential central bank, has embarked on an aggressive rate hiking cycle to combat soaring inflation. The Fed's benchmark interest rate, which influences borrowing costs across the economy, has risen sharply in recent months. While necessary to control inflation, these rate hikes have ripple effects across financial markets. Higher interest rates make it less attractive for investors to hold risky assets like stocks and cryptocurrencies. This is because safer investments such as government bonds are now offering more attractive yields. Section 4, High interest rates, a chill wind for risk assets. Bitcoin and tech stocks, often seen as high-growth, high-risk assets, are particularly sensitive to rising interest rates. Tech companies, many of which are not yet profitable, rely heavily on debt financing to fuel their growth. Higher borrowing costs eat into their future earnings potential, making them less attractive to investors. Bitcoin, while not directly impacted by corporate borrowing costs, is influenced by investor sentiment and risk appetite. When interest rates rise and investors become more risk-averse, they tend to rotate out of speculative assets like Bitcoin and into safer havens. Section 5. Navigating the storm: short-term pain, long-term potential. The current market turmoil is undoubtedly unsettling, but it's crucial to remember that market cycles are a natural part of investing. Historically, markets have always experienced ups and downs, and while the downturns can be painful, they are often followed by periods of recovery and growth. Understanding this cyclical nature can help investors stay calm and focused during turbulent times. Just as periods of exuberance and froth are followed by corrections, periods of fear and uncertainty often present opportunities for astute investors. These corrections can serve as a reset, allowing for more sustainable growth in the future. It's during these times that savvy investors can find undervalued assets and position themselves for long-term gains. While the short-term outlook for Bitcoin and tech stocks remains uncertain, the long-term growth potential of both asset classes remains intact. Bitcoin, with its decentralized nature and fixed supply, offers a hedge against inflation and monetary debasement. Similarly, tech stocks, driven by continuous innovation and technological advancements, hold promise for substantial future returns. Bitcoin, with its decentralized nature and fixed supply, offers a hedge against inflation and monetary debasement. As more institutions and individuals adopt Bitcoin, its value proposition as a digital store of value continues to strengthen. This growing acceptance and integration into the financial system could drive its long-term value. Tech companies, despite near-term challenges, continue to innovate and disrupt traditional industries. From artificial intelligence to renewable energy, these companies are at the forefront of technological progress. Their ability to adapt and evolve in a rapidly changing world ensures their relevance and potential for growth in the years to come. Staying informed, managing risk, and focusing on the long-term fundamentals are key to navigating the current market volatility. By keeping abreast of market developments and understanding the underlying factors driving market movements, investors can make more informed decisions. Risk management strategies, such as diversification and asset allocation, can also help mitigate potential losses. Remember, the best time to invest is often when others are fearful. Market downturns can present unique opportunities to buy quality assets at discounted prices. By maintaining a long-term perspective and staying disciplined, investors can capitalize on these opportunities and potentially achieve significant returns over time.